That's been an easy process over the last 15 years. Dips have been very short-lived. Recoveries back to new highs have been very quick. And so we've kind of been lulled into this false sense of security that I don't need to worry about risk management. I just buy stuff and it goes up and it's easy. Invest in stocks, they go up. Invest in whatever you want, it goes up. That will end. When it ends, who knows? But we're going to get back into a period, much like we saw in 2000 through 2013, like we saw in the 60s and the 70s, like we saw post the crash in 1929, the 1930s and 40s. We're going to get into this period where markets are still going to perform, but they're going to be a lot more volatile and returns are going to be lower. But that may not occur until 2030s. The rest of this decade may be just fine. Because again, there's a lot of psychology and emotion. There's lots of liquidity. We've got a whole generation of young people coming up that are speculating and gambling in markets, trading on Robinhood, et cetera. That liquidity push flows in the markets. Again, we can't ignore the impact of passive investing, where I'm not bullish or bearish. I just stick into an index and I just go on about my life. But all that impact, monetary flows into markets, continues to support markets. And we have a very dramatic change over the last 20 years of this rise of passive investing into the markets. All these ETFs, again, last year we had 1,000 new ETFs come into the markets. All that requires capital to fund them. If I launch an ETF and nobody buys it, it doesn't impact the markets. But if I launch an ETF and I can raise a couple $100 million in assets, I, as the ETF manager, can make money at that. I'm not going to be the next Bill Gates, but I can make a decent living managing a couple $100 million in an ETF from the fees I collect. But every time one of those ETFs comes to market, brings dollars in, those dollars buy the ETF, and the ETF has to go out and buy the underlying stocks. And as we note, most of these ETFs are not that different from each other, but a lot of them are all buying the same stocks. So in order to get AUM, I have to post performance. If my ETF is in an area that is not posting good performance, I'm not going to attract AUM. And so it's all a performance chase game, which pushes more and more of these ETFs to buy the same stocks that are all going higher, or to issue out an ETF to raise assets that are chasing a particular theme. You saw this with Bitcoin. Everybody wanted to be in Bitcoin, so ARK, BlackRock, Fidelity, everybody else came out with ETFs. So you could buy Bitcoin. Also gave the markets a great way to short Bitcoin, because now I can just short the ETF. So you also gave the markets an ability to arbitrage those trades. The problem with that is that when you brought ETFs to the market, you gave Wall Street the way to arbitrage off all your trades and to make money with it. It's going to eventually compress the volatility of those markets, leading to lower returns in the future. So these outsized returns that you saw previously are going to start getting compressed in the years ahead, to where Bitcoin becomes a normal asset at some point.
Catch me daily on The Real Investment Show. The link is in the description.